Welcome to the Monday version of the On the Tape podcast. I'm Guy Adami. I'm joined by Elizabeth Young. That would be EY from SoFi today. Dan Nathan, traveling for work, working on some big deals, as they say, really, really big deals. By the way, Dan had an amazing conversation with Gene Munster about all the tech earnings on OK Computer this week. Check it out, subscribe, smash the like button. It will drop on Tuesday morning. That's tomorrow. So go to the OK Computer feed and follow it, because you know what? A lot of things happening here. You got to be focused, got to be laser focused on all the different shows you're watching at the Risk Reversal Media site. Also, I want to thank everyone, Elizabeth, that joined the CME Challenge. Amazing turnout. We thank you. We hope you enjoy the hats. Good luck, as my people say. And today, EY, we had a great conversation with Reese Williams, CFA, Chief Strategist at Spouting Rock Asset Management. That's all the housekeeping. How are you?
I'm good. Wait, is the challenge over or did it just start?
No. The challenge is just beginning. The challenge began last evening. The challenge starts in earnest this week.
And here we are on a Monday. Again, Dan traveling for the second Monday in a row, leaving us to our own devices. Yes. Risky proposition, Mr. Nathan. Leaving these two to do whatever they want on a recorded microphone. He
clearly has confidence in us. He knows that, we're mature enough that we will not embarrass him, hopefully. I think he's at like some money show or fin show or something show. I'm not sure.
I was going to say, are we sure he's traveling for work? Because a lot of times when he says he's traveling, he's like at a football stadium or at a concert. But anyway,
well, I think there's like an amalgamation. I think there's a joining of the two. Speaking of things coming together, what's coming together? As it turns out, the 2-year yield and the 10-year yield coming together.
Good segue.
Nice segue in a major way. And again, I want to give you kudos. You said, I think you'll be surprised at how quickly this thing re-steepens. And as we're sitting here now, I don't know. I mean, we're about, 15 or so base, maybe less than that, which is remarkable
13.
When you think about it. We were 105 in the not too distant future.
Mm-hmm.
We're past,
I think actually intraday it hit 110. I might be wrong about that. But in any event, we got down to 12 basis points inverted between the 2s, 10s this morning as the 10-year crept above 5%. That happened a little bit last week as well, but really decidedly crept above 5% today. I think it went back down now, so don't quote me on that for when this actually drops. However, the interesting part about this re-steepening is what you'll hear from the bulls, the sort of rebuttal that we'll get from the bulls is that, it's happening because the 10-year went up, not because the 2-year went down. Usually the re-steepening happens because the 2-year went down as the Fed cuts rates in response to some sort of terrible thing that's happened and they're trying to save it all. This is actually because the 10-year is rising on the heels of growth being stronger than we expected. The consumer's still spending, retail sales strong, inflation still up, blah, 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 blah. So I get it. I understand that the reason the re-steepening is happening is because of the long end, not the short end. Here's the rub. Both of them are still high, and they are much higher than what we've been used to for the last 5 to 10 years. And I know everybody's been saying that too, so I want to put a little bit more detail around that. Why does it matter? Well, because if you're a company, if you're a corporation that has borrowed money to finance your operations or to finance growth, most corporate debt maturities are somewhere between 5 to 7 years, right? The average maturity, I think, on the high yield index is probably 6 something. The average maturity on an investment grade corporate index might be a little bit shorter or longer than that. In any event, they're borrowing somewhere between 5 and 10 years, let's call it that. If they've done that in the last 5 or 10 years, chances are the debt that they are paying for is at much lower rates than what it's going to be at if they have to refinance that debt in the next 12 to 24 months. And we happen to know that the corporate maturity wall is getting steeper next year and definitely into 2025. So that's a big reason why it matters. It'll affect small cap companies more so. However, this re-steepening is usually something that gives the market consternation. It's usually the thing that tells us that something bad is imminent. That is still muddy right now. However, I think that this is definitely something to pay attention to, and the rates being this high are going to be an issue for companies in the months to come.
Every time I have consternation, I eat Cheerios. It seems to do the trick for me.
I got to find a better word.
That's neither here nor there. No, but it's interesting, and I'm so with you. Obviously, listen, the Bulls and the Bears are dug in. The Bulls will see this as a positive, the Bears as a negative. I clearly favor the Bears side. I'd like to think I'm not dogmatic, but I look at this and say all the things you said on the Bull side of the equation are accurate, and I'm not suggesting you are that. You're just sort of amplifying what they say. But the reality is yields are going higher because the market's demanding a higher yield to buy our debt. I mean, it's a supply and demand thing. So yes, I think the market is more resilient than I thought. Yes, the consumer continues to spend regardless of whether or not they should be. But the reality of the situation is there are less buyers, and the buyers that are there are demanding a higher yield. And that's manifesting itself in this yield. And if you think about what's transpired over the last now 3 weeks or so, historically, you would have seen a flight to quality in the form of United States treasuries making yields go lower. And you saw that for all of 2 days when I think 10-year yields fell to about 4.55 or maybe a little bit less, somewhere between 4.5% and 4.55%. Yet here we are approaching, if not getting through that 5% level, which I think it doesn't mean anything technically, but the sound bells, the alarm bells are going to go off in a lot of different desks. And don't think for a second, we'll talk about the small and the regional banks, that this doesn't have impact on them as well.
The other thing I want to say about tightening is, so Jerome Powell spoke last week at the Economic Club of New York, and one of the things that stuck with me from that conversation was that he said something along the lines of there's still probably a lot of tightening in the pipeline. So we've talked about long and variable legs. He actually made the point that the long and variable legs were a phrase that was coined back when central banks were not as transparent. Now that central banks are much more transparent, the market tends to react before they actually make the move. So those long and variable legs may not be as applicable, but still a lot of tightening in the pipeline. The other point I would make is that a lot of times you hear from people who are more optimistic that, well, the Fed is going to be done. They're going to have to be done, and done means dovish. That's not true. I think Steve Leisman is actually the one who said that. Done does not mean dovish, something along those lines. The other point is that even if they are done, or even if they start to project cuts at some point in 2024, the bond market is continuing to tighten for them. So it doesn't even matter that they stopped hiking. The bond market is hiking for them, not to mention we've still got this tapering program that's going on in the background. So even if the Fed stops raising rates, stops talking about necessarily their policy rate going up, the market continues to tighten financial conditions, continues to constrict capital, and continues to put the screws to a lot of money that had been flowing around in the system. And I think eventually continue to put the screws to consumers.
It's interesting you say that, and I'm not an economist. I say this all the time, but I said on Fast Money last week, and I actually believe this to a pretty large degree. The Fed could decide to cut rates tomorrow, and maybe they'll have a one-day impact on the 10-year yield or the longer duration bonds, but it'll only last about that. I think yields are going higher regardless at this point. They control the front end. They control nothing else. And to your point, the bond market's doing a lot of the work for them, and it's out of their control, quite frankly. And given, again, QT, given the fact that Bank of Japan clearly not buying our treasuries, Bank of China clearly not buying our treasuries, and and the Federal Reserve is no longer monetizing that. I mean, who's the buyer of last resort that can buy of the magnitude necessary to keep yields lower? They're just not there. Mom and pop ain't doing it for them. I mean, around the edges it helps, but it doesn't make a dent. Now, I am not a particularly light sleeper. I sleep through pretty much anything. Although if the phone rings, I'll wake up.
For some reason, that does not surprise me.
But my sense is you're probably on a hair trigger. And last night, you woke up for some odd notion, and you woke up to a certain headline, and I'm going to read it to you because you and I have discussed this. Not this deal, but we've discussed this. Oh, Chevron to buy Hess for $53 billion in the latest oil mega deal. Shocking. Chevron agreed to buy Hess Corp for $53 billion, a deal aimed at boosting production growth as the United States oil industry bets on an enduring future for fossil fuel. Oh, an enduring future. Where have we heard that before? In an all-stock transaction, Chevron will pay $171 per share for Hess, 10% premium, blah, blah, blah. The acquisition will give Chevron a significant foothold in Guyana. I haven't been. The South American country that is one of the world's newest oil producers. Now, we have said this for a while, and I'm curious as to your thoughts, but I have said The best thing that's happened to the oil industry over the last, let's call it 6 or 7 years, number one, ESG. Counterintuitive, but you know what? It was a wake-up call for those companies. It forced them to focus on their business and be better operators. It worked. Number two, when crude oil the front month went to minus $39 a barrel, that was a slap in the face that the entire industry needed to figure out, again, production, focusing on their businesses, understanding margins, all those different things. No question about it. And the third thing is the Biden administration, who effectively ran on the platform, and this is not political, go back and look, we want to put the oil and gas industry out of business. All those three things would seem negative, were all positives. And here we are, ExxonMobil making that deal for Pioneer Natural. That was a $60 billion deal. And now this deal today. And again, as I said, with the Exxon deal, it's the first and won't be the last. And here we are 2 weeks later, whammo. My point is, if these companies thought that the extinction of their business was around the corner, they wouldn't be making deals of this magnitude. And it just speaks to the foothold and the strength of the balance sheets and how well these companies are run. So, and I'm not looking to play stock market with you, but I know you're bullish on the space. What does this say to you, Elizabeth?
Well, first of all, I want you to know that I am actually quite a sound sleeper and a vivid dreamer. I fall asleep pretty quickly. I stay asleep pretty easily. So for me to wake up in the middle of the night, I happen to look at my phone and see a headline about yet another transaction in the oil space. So here's the thing. What happened, I think, and I like your point about we got to negative $40 oil. I mean, it happened for a sniff, but still, it was an odd occurrence, and it was a signal. Companies and boards and leadership at companies are tasked with, especially publicly traded companies, I mean, all companies, of course, but publicly traded companies, because they're in the court of public opinion, are tasked with being good stewards of capital. So number one, they have to be good stewards of capital, control their costs, they have to spend in the right places. And part of what they should spend on is that old adage of, if you're not growing, you're dying. So for a long time, there was this belief that fossil fuel companies were dying and there was no reason to own them. There was no reason to get excited about them. And to your point, they have really changed things. And now we're looking at, which is a point I've made, I think, last week on the tape, there are two different ways to do M&A. You have strategic M&A and you have financial M&A. Financial M&A is the bad kind, because it's usually meaning that somebody needed to be saved. You're bailing them out. Maybe a bigger company is gobbling up competition, but only because the competition would have died, and you don't want to lose the entire industry. So this is strategic. This remains strategic M&A, where you've got companies trying to grow their presence, trying to grow their own abilities and increase their competitive moat. That, to me, sends the same signal that, you know what, we think this industry is okay, and the companies are healthy enough, they've got enough capital sitting around to engage in these transactions and move forward. So again, this is something that there's a lot of different reasons, I think, to be bullish on energy stocks right now. Now, they've seen a decent run, obviously had a tough beginning of the year, but they've seen a decent run. But bullish on energy stocks in the sense of, this is also a shareholder-friendly action, sort of indirectly, because if it's growing the capital base, if it's growing the company's strength, you want to be a shareholder in the future of that growth.
It's fascinating, though, that a deal of this magnitude. Remember, it was Chevron, I believe, 2 falls ago, if I'm not mistaken. Maybe it was, but my point is, I think maybe it was last fall, maybe it was this time last year when they announced, I believe, a $75 billion with a B dollar stock buyback. Now, oddly enough, that sort of signified, or that if you go back and look, that was a top tick for the stock. But the point is, again, the balance sheets of these companies, I don't want to say they're pristine, but they're the best they've ever been in the history of the energy space, because they were forced to have better balance sheets. Now they're putting those balance sheets to work. And I think it's extraordinarily shareholder friendly. And I think it's very friendly for the space. So I continue to be bullish at energy. I don't care what's going on with yields. I don't care what's going on with the dollar. I understand that things are slowing down. It's a supply-demand thing. It's also a geopolitical thing. And the stars are aligning for this energy space, I think, to continue to do well, Elizabeth.
It's more a supply thing than a demand thing. Because That's the other thing that's the pushback you get from people. Well, you're being inconsistent. If you're bearish on the economy, how can you think that energy demand is going to increase and drive prices higher? That's not what I think. I think that we're going to continue to have supply shocks and supply constraints, because that's the lever that countries and companies have to pull. So That I think that doesn't go away. Now, does demand get weaker in the case of what we expect to happen? If the economy slows down, if you see a contraction or a recession, yes, of course, demand gets weaker. And we're already seeing airlines suffer because of where gas prices are. So there are a number of forces that will drive demand down for a period of time. But I don't think that removes the supply shocks that have gone into the system and that I think will remain in the system.
100%. Could not agree with you more. It is a supply thing. We've talked about that. We've had Halima Croft on. She has mentioned it. Paul Sankey has talked about this. You've talked about it. And I think the market's starting to wake up to it. Now, this is right in your wheelhouse. So this is like, a 3-0 fastball that you have the green light for. So sit on this pitch. Wall Street Journal, never been a worse time to buy instead of rent. The cost of buying a home versus renting one is at its most extreme since at least 1996. The average monthly new mortgage payment is 52% higher than the average apartment rent. The last time the measure looked out of whack was in 2008 housing crash. Even then, the premium only peaked at 33% in the second quarter of 2006. So I don't know what to tell you. I know you watch these things extraordinarily closely, and here we are talking about levels we haven't seen probably longer than 96, but we'll go back to 96.
This is a topic I get really turned up about because there are so many different viewpoints, and then there's this whole idea of the American dream, which includes owning property, owning a piece of land, whatever you call it. There are times, if you're not forced to buy a house right now, don't do it. Because you've got all-time low affordability, not even just in the form of rates being this high, but prices being still overly inflated. And all it takes is if you've got a neighborhood, I actually saw a tweet about this last week and I thought it was really clever. Unfortunately, I don't remember who it was from and I won't be able to find it again. But it said something about a house in a neighborhood that was listed for, I think it was $700,000. And the idea or the speculation was that the rest of the houses in the neighborhood that were occupied by people thinking that their home was worth $1 million. And then the minute that home sells for $700,000, guess what? All the comps in the neighborhood come down too. And that it only takes one little move for that to happen. And houses are something that are only worth as much as somebody is willing to pay for them. And right now, because we have this stall in the existing housing market, there are not a lot of people out there willing to pay these prices or willing to borrow money at these rates. So housing right now, again, if you're not forced, I understand there are people who are forced for a whole host of reasons. Maybe you've been relocated, your family grew, you need to upsize, downsize, whatever it is. I totally get that. And in which case, sure, do it and probably refinance later. But if you're not forced into it, I think there's still this clinging to some sort of ideal of, but owning a home is the answer to the American dream, and owning a home is the answer to building wealth. Sure, over time, owning real estate can definitely be the answer to building wealth. It can be a hedge against inflation. It can be a lot of different things. Today, it was a hedge against inflation 3 years ago. Today, it's no longer a hedge against inflation. Inflation is coming down and home prices have not come down. Eventually, they will follow suit. But right now, it's not a hedge against inflation. And it's something that if you're trying to make a good financial decision for yourself, for your family, renting is not a bad thing. It gets such a bad rap. And, I sit here in New York City. Everybody rents in New York City. But renting gets such a bad rap. You've got flexibility. You've got time to wait out this market. You've got time to figure out what you really want, what you really need. You've got time to watch rates come down. So anyway, I'll stop there. And the last thing I'll say is there's a bunch of young investors, or I'm kind of a millennial, but there are a lot of young people who have been told or who believe that all they have to do to get rich is buy houses, flip them, and sell them, and finance the difference in between, and that will help you. In some circumstances, yes, that's been true. And I'm sure everybody's heard that story about the person who bought houses in 2009, flipped them, became a millionaire very quickly overnight. I'm telling you, that would not happen today because prices are too high. The borrowing rates are high. It's going to be a lot harder to get rich on today's housing market if you're doing it all starting right now.
Who sang that Genie in the Bottle song, like Sade or somebody?
Christina
Aguilera. Yeah. Well, at my point, by the way, we share a birthday. Not you and I, Christina Aguilera and I. Yeah.
Well, and Brad Pitt.
And it's a laundry list.
Wow.
But I mentioned genie in a bottle because that genie is now well out of the bottle and it's not coming back. Small banks look to shrink their way back to health. Now, good luck with that. By the way, funny thing about shrinkage is the more you think about it, the worse it gets, but that's probably for another show. But I've been looking at the KRE for quite some time. You got a kick out of that, didn't you? And the KRE, by the way, let's just sort of talk about this quickly. In April of 2020, the KRE got down to about 29 or so. Now, obviously, that was it's sort of at the peak fear of COVID. COVID lasted, but that was sort of obviously the market was getting crushed back then. KRE rallied. I think by January of 22, it was a $71 instrument. Now, things got interesting, obviously, this year. When Silicon Valley Bank, when they had the small and regional bank crisis in the spring, the KRE went down to about, I want to say it got down to 34 and a half or thereabouts. We have since rallied and we traded up to around 49 in the middle of this summer in August. Well, guess what's happening? As we're sitting here today, the KRE is sort of round tripping this entire thing. It closed, I think, at 39 and change on Friday, probably indicated lower. For those that care, this ETF is basically an equal weight ETF, effectively. M&T Bank, Truist, First Horizon, Huntington Bank shares, Citizens, Zions, you've heard all the names before. They're all in this ETF. Of course, the problem is with the bond market move, these stocks are starting to come under pressure, and we've seen it. KeyCorp said it would become a smaller, simpler company. I don't know what that means. PNC to lay off thousands of employees. I know what that means. Truist to downsize their books with lower returns. Citizens recently said they would exit the auto loan business and continue to scale back its mortgage businesses. It's all happening right before our eyes. This is what we talked about. You and I talked about this back in the spring, and we said, guess what? Too big to fail? Well, it's happening right before our eyes. These small and regional banks are going to get squeezed. You're going to start to see it in their earnings. It didn't happen as quickly as I thought. It's happening now. Thoughts on this? Because I think it has far-reaching ramifications.
Yeah, well, I mean, a very simple, and this is sort of tongue-in-cheek, but they're not abandoning product lines because they were wildly profitable, right? Obviously, they're walking away from some product lines or forms of lending because maybe they were sucking life out of the company. And I don't think it's any surprise either. I mean, auto loans. So just think back to how this all happened. Remember when used cars and trucks were the biggest problem we had? It was the prices were astronomical. You had to drive states away in order to get the one car that you wanted, and you waited 3 months to find it, and all these different things that we hadn't heard about cars for a long time. And now you've probably got a lot of people out there underwater on a car loan, which is a loan that you definitely don't want to be underwater on because you own a depreciating asset. The water just gets deeper. So it's not a good place to be. So people stopped borrowing money and for cars, and used car prices came way down. So probably not as profitable of a product line for those banks anymore. Mortgages we just covered. I'm not going to get back into that and get myself all excited. But there's a lot going on in the regional bank space that continues to put pressure on them. There hasn't yet been great news that said, oh, okay, you know what, that's going to help them a lot, aside from the Fed saying, we will give you a loan until the prices of these bonds recover. And that's the only thing that's happened, right? They got saved from that piece of it. We're going to continue hearing about the pressure on them. We're going to probably talk about balance sheet health, which ones were positioned okay, which ones were not positioned okay. And to bring this whole conversation full circle, remember what I said in the beginning of the conversation about oil companies. There's good M&A and there's bad M&A. Oil companies are currently engaging in good M&A for a strategic purpose. I'm willing to bet that in the financial space, some of these smaller and regional banks, you're going to start hearing about the bad M&A, which is the financial M&A, because somebody needed to be saved.
Are you a good witch or a bad witch? You remember that because, of course, You starred in your middle school or high school's production of Wizard of Oz.
That's right.
I'm not a witch at all.
One of my best friends, Stacy, played Glenda the Good Witch.
Stop it.
Yes.
Do we keep in touch with Stacy?
Of course, yes. She and I actually were birthday buds. She's the day after me.
Look at that.
Mm-hmm. Yeah.
So you played.
Which those of you who've been paying attention means that her birthday is on the 4th of July.
Yes. Well, no. We know that we wish you a happy birthday every year. If you don't recall, mm-hmm. we're very sincere in that. Now, I'm going to say this, and it's going to make me wince a little bit, so I apologize.
Santa
But
Claus
this is
rally?
a no, 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 no. I refuse that one. I refuse to use. But somebody coined the term "Magnificent Seven." Now, I am mortified by that because the movie, I believe it was 1960, if I'm not mistaken. It might have been a little later than that. But again, some of my favorite: Charles Bronson, Yul Brynner, Steve McQueen, Robert Vaughn. I mean, a laundry list. And of course, Eli Wallach was one of the bad guys. It's a wonderful movie. Now that everybody says Magnificent Seven in terms of these seven stocks, it really just it hurts me at my core, at a soulful level. But people talking about it. So you and I talk about it real quick. These stocks, they're on deck in terms of earnings, and they better come through because they are a lion's share of what's been going on in terms of this market. I mean, say what you want, but the market has been supported by the relative strength, I shouldn't say relative strength, the outperformance of these names. Now, we're seeing it with NVIDIA. I know you're not playing stock market, but NVIDIA has clearly rolled over a bit. Apple, to a certain extent, has rolled over a little bit. You say if you want to throw Tesla in there, that's showing some struggle signs here. It's going to be fascinating to see what Facebook has to say, what Google has to say, and what Amazon has to say in terms of earnings. And if, in fact, we start to lose the generals, Elizabeth, what it means for the broader market.
What I think is going to be really interesting about this group of stocks is that they've moved in unison based on AI, based on just enthusiasm, whatever it was. And actually fascinating, isn't NVIDIA still up like 180% on the year?
Yeah.
Even with what it's given back. So what I think is going to be interesting, and earnings may be part of the catalyst that does this, is you've got companies in there that are driven by very different things. Obviously, all of them dependent in some way, shape, or form on the consumer, but the way that the consumer uses Amazon is very different from the way that the consumer affects NVIDIA. And I think you're going to start to see the stocks pull away from each other. I'm not going to make any predictions about who's going to do well and who's going to do poorly, but you've got, Meta in there as effectively an advertising and social media company. You've got Amazon in there as a consumer products company for the most part. You've got NVIDIA, obviously, that's down the supply chain for other things. You've got Apple, we're all kind of stuck into this ecosystem with. So I think that they're going to start being affected in very different ways by the way that this plays out. The reason this earnings season is so important, and I know we say every earnings season is important, and this will be the most important one until the next one, but the reason this one is so important is because it's possible that this could, if we eke out a very small positive growth number, this could mark the end of the earnings recession. In which case, if you look at the sequence of events, that means that we've had a stock market pullback. So we had the bear market last year. We've had the earnings recession. The next piece, the third and final piece of that puzzle, is the economic contraction. Now, if everything continues on that same sequence and we don't get stopped or misguided in the meantime, the economic contraction may not be so bad. We had a stock market pullback that was kind of cute. We had an earnings recession that was equally cute. And then we might have a little contraction in the economy. However, this is also happening at a time where we're having a pretty decent, now getting to be a bigger pullback in the market. There's a chance that the market is sniffing something out bigger than what we've already seen. So you've got this earnings season that might mark the end of it by 0.7% growth. But what if it's a head fake? And I think that's the thing that we have to think about and look forward into 2024 in the sense of you've still got earnings growth expectations for double digits. Calendar year 2024, that seems exorbitantly high given where revenue expectations are. And I just would be very careful to declare victory on an earnings recession and declare victory on the sequence of events that, okay, we just have to have this little tiny slowdown in the economy and then we wash our hands clean and we move on.
I'm going to declare a victory on this podcast. I'm going to leave by saying, in terms of economic data, we have flash PMIs tomorrow, 9:45 a.m., both services and manufacturing, new home sales on Wednesday, initial jobless claims and GDP on Thursday, along with durable goods, retail inventories. Friday, we got personal spending, personal income, PCE, core PCE, consumer sentiment. We got a lot of economic data. Throw on top of that ExxonMobil this week, Bristol Myers this week, United Parcel Services this week, that's UPS, Mr. Softy, Facebook, just a laundry list of companies reporting as well. throw Google in there, and you know what I'm talking about. Elizabeth, this has been a joy for me. I hope it's been enjoyable for you.
Of course it has. I feel like
You
I rambled a
paused.
little bit
No,
today.
you don't ramble.
Yeah, I
No,
just,
people are here to. Can I? I'm going
fired
to
up
be.
this morning.
People are here to listen to you, and I love it when you go down these rabbit holes because you do the work required to understand how to get down them in the first place that a lot of people are unwilling or are not knowing enough how to do. So it's wonderful to have you here, EY from SoFi.
Well, thank you. It's always wonderful to start my week with you. And we miss you, Dan.
We not really. We got Reese Williams, chief strategist at Spouting Rock Asset Management, coming up. So listen for that. That's going to be fun. And remember, go to the OK Computer feed and follow it because Dan had a wonderful conversation with Gene Munster. They're talking tech earnings this week. It's dropping tomorrow. We will see you later, folks.